Hello, everyone. My name is Xavier Williams. I'm the marketing manager here at Elash Apartment Group. Welcome to Apartment Connections, where we bring people together and share tips and tools and insights that will help you be a successful apartment investor. And the main reason that we do that is so you can take back your time to reconnect with the special people in your life. We know your time is valuable, so we're going to get straight to it tonight. We have Elash. Oh, sorry about that. We have Eli Weikart, right?
Weikart. Yeah, we're close.
Weikart. Uh, Perfect. I got that right. Eli. Sorry about that. Eli brings a combined 10 years of experience to the Columbus market in property management, business development, and sales. He started working in college at student housing in 2014 while pursuing his master's degree. Congratulations. And moved into Columbus 2017 to begin a sales career. Eli has been with the CoStar Group since 2022 and oversees 1,200 individual clients between CoStar, Loopnet, and Homes.com. Eli, thank you for being here today.
Good to be here.
That's awesome. Would you like to start by telling us a little bit about how you got started and what you're working on now?
Yeah, good intro. I know I wrote it, but still good intro. Yeah, so for those listening, I've been with CoStar for coming up on 3 years. A little non-traditional background getting into commercial real estate, but I actually have a master's degree in higher education administration. Thought I'd be working with the next generation of college student leaders, but the way that workforce tends to matriculate, it rounded me out into running a dormitory up in Cleveland State for about 2 years. And if you've ever worked in student housing, you know that there are a lot of problems. About a third of them are the kids, and two-thirds of them are the parents.
Right.
So, a couple
Okay.
years and 90-hour work weeks there. I got recruited for a sales role down here, and been in software sales now for the last 7 years. And CoStar, got connected with them through a recruiter with apartments.com. And pretty much the rest of its history. I learned a lot about the commercial real estate space over the last 3 years. I work with everything from brokers, owners, developers, and even some vendors and economic developers throughout the Columbus region. We leverage a lot of data to help people make just data informed decisions around acquisitions, around underwriting deals, prospecting, sales. So kind of do it all, sales and service. Fortunately, real estate is such a social business that I've had the chance to get roped in with a lot of different people, and it's led to opportunities like this to speak to groups.
That is awesome. You have a great career, and I definitely see you're crushing it out there, man. I see all the great work you're doing in the real estate community, and it's admirable. I really do like it.
Thanks.
No problem, man. Do you want to just get straight into it?
Yeah, 100%. So,
Perfect.
um, sorry if I call you Matt. You're showing up as Matt Angle on my screen,
No
but
worries. Just look at me as he got a tan. So
yeah, yeah, right. It makes two of us. All right, hold on. Let's get this screen shared. Is the power of knowing is the main slide popping up for you, man?
give me 1 second. Oh, yep, there you go.
Awesome. Okay, so I put together. So for those of you who are either here or listening, I put together some slides that reference the state of the market event that we had recently. I'm going to kind of kick it off with an intro to CoStar if you're not familiar. So, who are we? Why do I have access to this data? Why should you care? Why would you listen to me? Some groups I work with, and then I'm going to give you both kind of a big picture on what the multifamily world is doing over the past few quarters, as well as Columbus specifically. And then I'm going to break it down by even asset class. So like classes A and B, and then C separately. Full disclosure, I'm not a market analyst. I am not the market analyst. This isn't necessarily my background. I'm software sales. I just spend a lot of time consulting with clients. I try to be a student of the game. and latch onto anything that I see covered that I think can be relevant to cover with groups. So I didn't build these slides, but I think that I have enough of an understanding in my daily life to be able to convey them to you guys. But Xavier, feel free to, stop me, jump in if you have any questions on this information. Let's go ahead and proceed forward. So I mentioned CoStar Group. We are a national research organization. We own a lot of different brands. The main one relevant to this call is apartments.com. We use that to determine renter-driven search behavior, rent comps, occupancy, concessions, all of that good stuff. But what we would define within our data set and what we track is multifamily units, 4 units and up. That's where commercial lending starts. So although we do have some duplexes, triplexes kind of floating around CoStar, really 4 units and up, and even, broadly speaking, the clients I deal with are the ones who are dabbling with a lot of 100 plus, 200 plus units, class A and B, and even developing things. So here's some just kind of like my little brag board. Some slides of names you might know. Daimler, who just recently completed a really awesome project in the peninsula. Casto, who's literally building the new development with the Lucky's Market, and then this 300-ish unit multifamily that's right outside my window right now.
Okay.
Crawford Hoying, Bridge Park, Pizzuti, a lot of the stuff in the short north. Link, who does a lot of like workforce housing. Woda Cooper is an affordable housing group. Thrive is a lot of the stuff in Italian Village, The Sage, Jeffrey Park, and then Kaufman, I think Greenhouse in the short north, and Gravity in Franklinton. So just some projects you guys may be familiar with, but those are some of the friendly faces I get to work with every single day. So CoStar, if you're not familiar, we are a research organization. We are one of the largest census departments in the entire nation, a few steps behind the actual US Census itself. But we are solely dedicated to commercial real estate, which makes us a pretty much the player in terms of commercial real estate data and census and analytics. All of the things that I'm going to cover, all of our data is sourced from 3 different areas. So number one, we have an in-house research team that's made up of about 1,600 researchers. They sit here stateside in Richmond, Virginia. We also have a multifamily specific research team, researchers in each market, as well as like tenant researchers and things like that. Their entire role is to be calling and following up on brokers, owners, developers. Anytime we see a deal transact in one of our marketing platforms, we'll follow up, get the sale comparable, get the lease comparable, get the true owner data, the contact information, all that good stuff. We have the largest drone fleet in the nation, and we recently bought Matterport, which is the 3D kind of walkthrough you may see on apartments.com as part of that advertising package. Number 2, Loopnet and apartments.com. Those are going to be the most relevant here. Loopnet is where you would go to buy or sell a multifamily building that's commercial, and apartments.com is where you're advertising that to the end users or the residents, as you probably know. Apartments.com, I owe a little bit of fealty to, because that was how I got in the door here, was going through a recruitment process with them several years back. We own a few different other brands, 10X, which is an auction platform, Biz by Sell, Land.com, now Homes.com as well. We've rebuilt that. Kind of remains TBD to see how we really venture out into the residential market. But Homes.com does, we do have a lot of home, like single families that are pulled out of homes and also advertised on apartments.com for our premium members. But basically, this is how we scale up a large set of data, because somebody puts a property for sale with a number of different amenities, or says, hey, we have X number unit count, we have these amenities, here's the floor print, here's the photos, and they're listing that on apartments.com. Instead of having to like cold outreach and gather that information from a research method, we basically just export it into CoStar and use it as part of the research.
Okay.
So I do a lot. Apartments.com is a huge selling point for a lot of my multifamily clients. I was just talking to a pretty prominent developer today, and these conversations are very fun because you learn about how things progress over time. Last but not least, we have a lot of third-party data feeds, things that are relevant to this conversation. Intex that has so that's CMBS loans. So they're federal mortgage-backed security loans. They're basically, if you want to see like who has distressed debt or maturing or watch listed loans coming up in the Columbus market on multifamily, that's a great tool. People use it to source off market or value add deals. First American is like our like public record. So, kind of tracking parcels, who owns stuff. Newstar, that's like our demographics tool. So essentially, like, hey, if you want to underwrite a deal, you're looking for the 135-mile radius on who has, like population growth, age, race, educational attainment, all of that breakdown, and some other stuff. Morningstar for companies that we track as tenants and things like that. So that's where all the data that I'm going to cover is sourced from. It's a tremendously fun thing to sell, to be honest, because it's an incredibly useful tool, as you can imagine. Nobody really does what we do, so it's really neat, and it allows me to get to know a lot of people who are literally building the skyline and learn about a lot of projects. So with that being said, here is actually, Xavier, do you have any questions that might benefit the group before I move forward?
Right now, no. I just say the benefit of, having co-stars, you don't have to go out and look for all that information yourself. It's all in one place. And then there's also some extra things that you guys do as well. I have used co-star in the past. You know, news is always consistently updated on co-star and things like that. So, I no questions at all. I think
Right.
we hit everything on the nail.
And for those of you who don't know, Xavier was actually one of my clients at one point. So it's always kind of fun to circle back with people. So we're going to look at state of the market nationally, and then I'm going to zoom in locally.
Okay.
So there's a lot of trends that echo what's going on in the multifamily market nationally. Columbus is better off than a lot of different submarkets. There's some things that are going well. There's some things that are not. Xavier sent me a lot of really well put together questions that I'll try and pepper in the information that's related to, like, hey, what's a challenge for people in the market, what makes maybe a deal attractive to people, what kind of amenities, things like that. Candidly, I don't personally own anything. I've definitely looked at some of my own deals over the past couple of years. I'm hoping to get there eventually, but I do spend enough time with developers and owners, just to preemptively answer some of the things Xavier asks around, like target amenities, things that make a deal attractive. It's a terrible answer, but it really just depends, because sometimes people like value add. Sometimes people like to build things that are high end amenities. Sometimes people have built high end amenity things in markets that really can't support them.
Mhm.
So we'll talk a little bit about that. But so, anyways, one of the metrics that we use in the commercial real estate data space is this topic of absorption. Google can probably explain it better than I can, but basically it's how much you accounting for construction, how much new units are absorbed by the market, or for every, unit that is built, how many has a person moving into it versus a
Mhm.
person moving out of it. So essentially, like negative absorption, more people are moving out of spaces than are being delivered to the market. Positive absorption means that spaces are entering the market, but they are quickly being backfilled by the population. So that's a term I'm going to use a few different times. Like I said, Google can probably explain it a little bit better than I can, but just to help paint the picture, if your deals are starting to get larger and larger, you may not be using that metric quite as much. But it's something we use to track the market analytically.
Right.
So basically, what's been happening since 2021, a lot of product has entered the market. That's going to be a theme nationally and locally. Right now, this quarter, you can kind of see over the last like 7 or 8 quarters, this is the best quarterly absorption we've had since 2021, where it's actually to a point where we're matching supply.
Okay.
The demand, I'm going to use terms like 3-star. 3 stars a class C, 5 stars class A, 4 stars class B, 3 stars class C. We use that to basically apply like a national standard, because a class A building in downtown Columbus may not be a class A building in Manhattan.
Right.
But a 5 star is a 5 star anywhere. And that's kind of how we determine it. So one of the themes here nationally is that class C, C to B, demand is also growing. It's the highest it's been since 2021. It's aiding the overall stabilization. You can see the orange bar. So obviously, this blue bar, I hope you can see my mouse, but this blue bar
Mhm.
is basically the 4 and 5 stars, so the class A and B. Stabilization's been growing. However, 3 stars at its highest, and you can see it's been much smaller over the previous quarters. Um, the good news about all of this is that over the last 5 years since 2020, developers have been putting their shovels in the ground. They've been building, and a lot of those units are being delivered. So if we look at 2023 and 2024, that is like peak delivery, and I believe that there's actually been more units delivered than a lot of people anticipated in the market. We are forecasting somewhat of a delivery fall off in 2025, which means that less product entering the market is going to mean good things for vacancy and for rent growth. So this chart is basically showing that 4 and 5 star rent growth is at its weakest over the past couple years. So kind of a theme is Class A and B is being delivered a lot. The rent growth on these nicer products is basically starting to shrink. It's heading negative in some cases. You can see Q3 of 2023 rent growth actually dipped negative. Last I looked, there's a lot of markets that are, if not modest, they are dipping negative, and I have a slide to show that. But again, back to this theme of like nationally, these 3-star Class C properties have actually been holding pretty steady from a rent growth standpoint. This is an economic forecasting model that we have put together. Basically, we forecast out, we use Oxford Economics as one of our modeling tools, but we basically look at net absorption, net deliveries. So again, what's being delivered, what is having people move into it, and then what's the overall vacancy look like. Generally, from where we forecasted, we hit kind of a low at around mid 2021. But then vacancy has since been growing nationally, and we expect it to peak, it looks like probably over the next like 6 to 12 months or so. And then
Okay.
hopefully a modest decline, which I'm going to get into this in a minute, but basically the tightening vacancy means good things for rent growth. If you guys have not been directly experiencing it, it does generally, when you have a lot more vacancy, you're not able to demand as much rent growth because there's just too much supply, right? Supply and demand.
Right.
So
Basic
that's
economics.
basic economics. So that's nationally what's going on. To pivot into where the like locally we're seeing things happen. Couple of these slides are actually gonna be surprising. They were surprising to me. They may be surprising to you guys as well. So I've always thought that Columbus was the fastest growing market in the Midwest. We see a lot of news articles. I think in Columbus, we like to scratch each other's backs and hype up the city and the growth and intel and some of this other stuff. It turns out Indianapolis has actually had, from at least a percentage standpoint, a slightly higher growth factor over the last 2 to 3 years than Columbus. We are number two. Honestly, I couldn't tell you why Indianapolis is ahead of us, aside from just like there's obviously a lot of manufacturing and blue collar work out there,
Right.
and warehousing and distribution, things like that. Other ones, Kansas City growing. So those three are outpacing the U.S. average of a 1% growth rate. Cincinnati slightly below, but still in positive growth, and Minneapolis. Cities that are shrinking: St. Louis, Detroit, where my heart is at, Cleveland, Pittsburgh, and surprisingly Chicago as well. So just in terms of like understanding, maybe if you're investing outside of the market, Columbus still has, I would say, the most positive upside. Indianapolis just seems to be edging us out. This is the other slide that I thought was very surprising because everybody's thinking about population growth related to Intel, related to the Northeast quadrant of Ohio. And there's a very targeted focus from special improvement districts, downtown economic development groups to really bring a lot of people and population downtown. And there's a lot of construction that's going to reflect that we're adding a lot of product downtown. But if you look at county by county, where we're seeing census data projecting or documenting population changes, Union County, I didn't expect that, but like Union County is actually the highest growing by a percentage standpoint. Doesn't mean number of heads added,
Right.
but from a percentage standpoint, Union County is currently the fastest growing part of Columbus. Delaware, I don't think that that's going to be surprising to anybody. Delaware County is the highest educated and I think highest earning county in like the state of Ohio.
Yeah.
It is bringing a lot of that labor that we expect to feed New Albany, the Intel plant, a lot of that knowledge work, and a lot of the direct and indirect labor that goes on with that economic development project. It seems like it's probably just going to be a suburb of Intel. One of the unique things, so Delaware County Economic Development Organization is my client, and we talk about commercial real estate use cases, things like that. Delaware County, because so many people live there, but there's not as much blue collar work or manufacturing or distribution or just general office jobs within Delaware. There's not enough tax dollars to really um, offset the taxes that the residents would be paying. So there's still a really high tax rate in Delaware, which is something the Economic Development Department is struggling with. They're trying to bring more white and blue collar labor to Delaware County.
Okay.
Then followed by Pickaway, Fairfield, Licking, Morrow, and then Franklin County has a modest growth, and then Hocking is growing in the inverse, which is interesting because it seems like everyone is vacationing there right now. So I mentioned that a lot of deliveries are, doing a lot of things, you know, in some ways positive for renters, but for us as investors, challenges around vacancy rate. So the green bar represents the overall vacancy from a percentage standpoint. Yellow is absorption, and then blue is delivered. So blue is what projects are being completed. Yellow is what's being filled, and green is what the vacancy rate is. You can see here that basically we have had vacancy rising since late 2021, pretty precipitously. It's been very steep, and this is a bit of an inflection point. Doesn't mean it won't go down, but again, based on the blue line, so the deliveries slowly ticking downwards, and the absorption ticking upwards. What we are forecasting and seeing right now is a dip now in vacancy and somewhat of a tightening. So forecasting that out, we hope to see a little bit of relief there in terms of vacancy. There's a lot that goes into that, but when you're underwriting deals at a certain vacancy, at a certain rent growth, and that's not the case, it creates a lot of challenges, especially with lenders. So availability rate, I won't spend a ton of time on this, but basically we are the third most in terms of current availability. And it looks like we're kind of right up there with vacancy as well. Again, kind of back to that theme around 3-star. The vacancy tightened in this quarter for the 3-star. The demand for 3-star, the demand for Class C, is actually trending positively. Net absorption. So I mean, just a lot of people entering into product at Pickaway, Southern, and then Columbus is kind of like as a market. We're seeing some of these outlying counties again with a lot of absorption, but Columbus kind of falls smack dab in the middle. Here's the thing though that I do think is interesting, a little bit of a challenge is construction. You can see it trending downwards, right? You can see that we hit a peak from late 21 or late 22 to early 23. And the share of inventory and the overall square footage under construction is trending downwards. But the problem with this graph is it's still well above average. So it means like we are still building, especially forecasting a large population growth in this market. If you guys want to see where the most construction is going on right now, Delaware County, not surprisingly, again, that is one of the highest growth areas. And again, like kind of thinking about Union, I think that just generally speaking, that percentage change may not quite reflect the overall heads that are entering the market. It looks like the most amount that's entering the market right now is Delaware County. Some of these I think are kind of interesting, like Upper Arlington. I don't necessarily think about like all of the hotbed of stuff. I would say that you could attribute some of that to Grandview, because we do consider Grandview to be part of that Upper Arlington submarket.
Okay.
Guys, there was a ton of stuff coming in downtown Columbus, and I'm going to show you a snapshot of what I see in a little bit in terms of the overall construction piece, specifically focused on downtown. A little bit in the southern side. Nothing recently completed in Hilltop, but a lot of stuff beginning to go under construction. And then followed by Northeast, Union, Licking, Bexley, Madison. Doesn't look like Madison, Dublin, and Pickaway really have anything that's currently under construction. Just a lot of stuff getting delivered. Okay, so with rent growth, and I'm gonna go off on a couple of anecdotal tangents. And again, like, full disclosure, not an analyst. I'm going to tell you a few things I've heard from other people who are executives in both marketing and advertising positions here with CoStar and apartments.com, and some stuff I've just kind of independently read. So Columbus does have a still decent amount of rent growth. We're at 3.2%. That puts us in the top 50 markets. I was kind of surprised to see Louisville. Louisville's been on a lot of these slides in terms of rent growth. Richmond, where we're headquartered, DC, and then we're slightly below Cleveland and San Jose. The flip side of this graph, you're going to see, probably unsurprisingly, but maybe surprisingly, really hot markets like Austin are experiencing the worst amount of negative rent growth out of anywhere. Some of that stuff in the Sun Belt, Tampa, Charlotte, I'm thinking the South, I guess, in general, Nashville. A lot of these guys are experiencing negative rent growth. Anecdotally, probably people who move down there to work from home remotely, and there's been a lot of stuff built down there that's not keeping up with supply. We'll talk about that in just a second. But real quick anecdote, I was talking to our VP of sales at apartments.com. He works out of the Columbus office. He is in charge of, I think it's 18 states, and really just, kind of like managing revenue. It's in, it's out, people meeting sales goals. As you know, when vacancy is high, people are going to spend more money on apartments.com advertising, right? So high vacancy is good for business for us. What he said is that a lot of people who have underwritten deals and, across all these states said Columbus is a little bit better. Nationally, at least the states I'm in charge of, we are starting to see flat, if not negative, rent growth trending. The challenge here is a lot of people have underwritten their deals, assuming unlimited rent growth or consistent rent growth over the life of the deal cycle. And suddenly a lot of stuff gets built, a lot of stuff enters the market, vacancy goes up. You can no longer push rents higher and higher and higher when somebody can move right down the street. So this challenge right now is a lot of people are finding challenges or trouble with their lenders because, again, they've underwritten deals assuming forever positive rent growth, and now it's flat, if not trending negatively in a lot of these markets. I'm not saying everywhere, but there are definitely a lot of markets that are experiencing some negative rent growth. I pulled this off of LinkedIn. So Jay Parsons, if you guys are looking for, if you guys follow me on LinkedIn, totally do it. I just post about sales stuff most of the time. Jay Parsons is a really great economist that I like to follow on LinkedIn. He always has different inputs just around like what's going on in multifamily space, in the rental space, and has a lot of great insights. I think sometimes these folks have like a sky is falling mentality. Charles Montreux is another really, really good one, but he does more of the general broad market and securities and things I don't always understand. But I pulled this off of LinkedIn. I wanted to highlight a couple parts I thought were relevant because it does tell the story of some risk, especially associated with a market like Austin. If you guys think about over the last like 4 years, at least since I've been in real estate, I've been hearing a lot of like, oh, Columbus is like the next Austin. I've heard that. I've probably said that.
Me too. I've said it.
Yeah, right. It's not just us. So Jay put this post up maybe about a week and a half ago. He posted the 15 submarkets posting the deepest rent cuts right now among market rate apartments. Not surprisingly, one metro area is claiming 9 of the top 15 spots. Remember, Austin was negative almost 5% rent growth. Don't even need to look at it to know it's Austin. I get asked a lot about Austin, and he goes on to say, "Is it weak demand? No, it's not. It's not that. Is it tech workers? boomeranging back to California? Is it people moving to Austin not liking it? It's not that. Rents have everything to do with supply. So 6 of Austin's 16 submarkets grew their apartment stock by 10+% over the last 10 months. So if you think about like you have 10,000 units, that is now suddenly 11,000 units in the span of a year. Seven sorry, so which is massive. Seven still have at least 2,000. So 7 of these submarkets have at least 2,000 plus units under construction per submarket, and another 4 submarkets have at least another 1 to 2,000 units underway. What people are forgetting about Austin is it's generally still a small city, which I think would also qualify Columbus, right?
Right.
So smaller geographic area, he calls it a one highway city. I think that's fair because we have 70, 71, and 270. But he classifies it as a still maturing market vulnerable to boom and bust swings. Might
Okay.
might be like a Columbus, right? Um, Basically, unlike a Dallas Fort Worth, like a really big, robust market that has a lot of diversity among product, diversity among submarkets, it can't quite weather the boom and bust swings, but it's going to keep growing up. It's going to grow out of it. It's short-term pain, long-term gain. Austin still has a lot more apartment renters in here. More people are still moving there, but it's not enough to keep pace with a ridiculous volume of new supply. Ranking tops nationally relative to size, it's going to take time just to work through that amount of supply. Top right hand side, the other thing to remember about Austin is it's more than 60%. So over half the apartment stock has been built in the last like 24 years. So very new. A lot of Class B. The Class B is still relatively nice and new. So like new products
Right.
entering the market, it's not like, hey, I'm gonna move to this brand new building because it's brand new and everything else in my community was built 50 years ago. I live in a 60-year-old building. I like it, but whatever. Basically, it's like, hey, I can choose between a 1-year-old building or a 6-year-old building, right? It's not going to be super different, especially in the Class B and C space. So basically, it says Class B, C renters are easily able to move up to newer lease ups than in other metros, which means that Class B and C reflecting a deeper rate cut right now. If you remember some of these previous slides, we do see it a little bit in the A and B space nationally. C is somewhat stabilized, and this is unique because they have newer product, but generally speaking, like there is some risk with like that class B, I'll say. Just kind of quick look at the graph. So Southeast Austin has experienced a negative 12% rent growth. So the rent has dropped 12.8% on average year over year in Southeast Austin. We have one in Jacksonville. Then we have the next like 3 are in Austin, Cedar Park, far south, far west. Each of these are taking a 10% haircut on their. So basically, you're charging $1,000 a month. This time next year, you're only able to get $900 a month for that same unit.
Oh wow.
I think that was all I had kind of related to that story. Um,
Would you happen to know how is Austin's rent? How is it compared to the other major metropolitans in the area, in the Texas area?
we can look at it. I heard it's expensive. I don't know off the top of my head like what it necessarily costs. I think there was a lot of. I mean, I think with Austin, there was a lot of really fast rent growth over the last like 4 years when there was a lot of growth during COVID. I think rents grew faster than probably what they were prepared to support. It's probably a correction more than anything else, not
Right.
necessarily a bust. But yeah, we can look and see what the average rents are in a little
Yeah,
bit if you
yeah,
want
we
to.
don't have to. I just wanted to confirm that because I heard that as well. I heard that like back in COVID or something, rents were sky, were just going crazy out there. So
I
uh
think it's expensive.
yeah.
Yeah, and then just kind of reiterate some of these other points. Like we're starting to see some reacceleration in rent growth in that 4 and 5 star. So we're slowly getting to the point where the 4 and 5 star, if you can see though, it's been very, very low. And we're starting to see the nicer product having slowly growth up here. Whereas again, that class C has been um a decent rent growth consistently, and then actually the lower end product has still experienced some rent growth as well in Columbus. The market stabilizing, so basically, moral of this story, like as things are being delivered and we expect a little bit of a lull here, and maybe demand, just demand slowing down, which slows down construction, which then in turn leads to the cycle of more demand, which more construction. But for now, we are at a point where we expect to start seeing some modest rent growth again as the market stabilizes, and even some vacancy tightening over the near term. So where we've been sitting around, we've been peaking kind of around 8.5%. We're expecting it, or at least forecasting it in this slide, to go maybe down a percentage point over the next few years. So again, that's me trying to kind of reconvey some of the stuff that our analysts have put together and delivered a couple weeks back. What I wanted to show you guys is some stuff that I was able to pull from the CoStar tool. So a few different things. We definitely track the construction market, especially when people are in lease up. New product, we'll document that in the CoStar tool. We have a Cessna that canvasses every market about once every 12 months. And photograph kind of the progression of the construction and things like that. So I just put together a few slides. This one is really the under construction pipeline in Columbus. So we've talked a little bit about some of these outlying counties. We definitely see a decent amount coming up in what you would consider to be that larger Delaware County, which encompasses Westerville. So you're going to see it up here, and then a little bit of Delaware proper. And then, like I said, guys, there was a lot of stuff that's being built in downtown Columbus. But again, a decent amount of that stuff is going to trickle into what we would consider to be the Upper Arlington submarket. And then we also have a lot of, again, like kind of focused effort on growing the supply and growing the population in central Columbus. A little bit on the west side, a little bit on the east side. And then scattered kind of here and there on the east side, and then nothing really going up directly near Intel right now. But we have about 50 properties under construction. Here's kind of a snapshot of the analytics of what we have. So right now in Columbus, we have 10,374 units that are currently under construction. So that is a lot. Some of this stuff is starting to get delivered. So there'll be some tightening, or at least things kind of flattening out a little bit. The market rent per unit, at least the construction piece, we could probably gloss over this because it's going to be new product delivered and it's not all going to be marketed. When stuff is selling that's new, we're probably looking at 153K. Sale price and cap rates advertised around 6.5%. This is the deal volume and the transactions we have seen over the past 12 months in the multifamily space. Up here in the top right-hand corner, you can see there's 111 records of properties that have transacted over the last 12 months in Columbus. As you can see, a lot of that stuff is actually kind of trickling over downtown into the east side. There's a lot in the Upper Arlington area. Less is selling in the Delaware market. And if you exclude a little bit that's going on in the Huber Ridge and Westerville areas. But we're building over there, right? A lot of stuff's also been transacted over in Newark as well. Here's a glimpse of just kind of the overall sale volume. So sale volume, we've had about $360 million of transactions occurring over the past 12 months. So $360 million total transactions over the last 12 months. Product is sitting on the market for about 6 months. Average unit count of these is 71. That's really an aggregate, not the mode. And we're selling for about a 7.8 reported cap rate and sale price of about $135,000 per unit. I guess that is everything I had put together and prescribed. So that is a ridiculously large Q&A. But I wasn't sure exactly how this was going to be structured. So I wanted to kind of open it up if there was either specific submarkets that folks were interested in taking a look at, or just general questions around either the data I shared or just kind of what I'm hearing in the market.
Personally, I don't have any questions. I don't think there's anyone on here to ask any questions. So I guess we can just call this it, man.
Yeah, 100%. Let me just look at the text you sent me, man. I want to see if there's anything else that jumps out. Key factors. So you asked me a couple really good ones. I'll try and take these. Can you tell us about recent trends you're seeing in the Columbus rental market? How has the market shifted in the past few years? Like I said, totally depends on what people want. I'm seeing a lot of merchant developer new product that's working for some people. And then I'm seeing a lot of, I would say, redevelopment. This is anecdotally. I can't really give you hard numbers on this. I
Okay.
do think a lot of people like the like the entry points in terms of like something that's rented below market. Maybe some capital improvements can be made, but nothing that's necessarily super distressed. What are key factors that make a property attractive to renters today? Um, Attractive to renters, that's a good one. I think I'm definitely how have renter preferences evolved over time. I couldn't necessarily tell you. I mean, I definitely have, a lot of friends who love the pool amenity. I don't have one. I still have like quarter laundry, like an old person here. I live in New York with townhomes.
Okay.
And I've lived here for 7 years. It's very convenient for me. What's in like location's very important to me, right? I do think that maybe a larger trend that we might see is these live work play type areas and how people kind of expect to maybe have like a community that supports where they're living.
Office work and things like that.
Yeah, so like True Point's a good development example that's going up in Hilliard. It's closely modeled after Bridge Park, which is it's almost European, right? We have the entire first floor is retail, the middle couple floors is going to be office, and then the third floor is going to be multifamily. I think that the location is important. I love having a very affordable unit close to the short north. That's what's important to me, because there's not a lot of product here that isn't like a duplex or a house. So being near that market is great. But if I was working in Dublin, I would probably consider a Bridge Park. For
More
those of
so,
you,
just I see what you're talking about. It's like a combination of the co-hatch experience,
yep.
uh, with with living as well. I've seen that across the United States, just by visiting different markets.
Yeah, I think globally that that model is definitely coming back. I think you're seeing a lot of economic and special improvement districts realizing that like just like Dublin is a good example of an area where like the collection of like old office buildings in one big business park just doesn't work anymore. And now trying to have like a targeted redevelopment around where people can live and be near everything. I think it's going to create some like micro communities, right? Like if like it feels like the top competitor to the short north right now is Bridge Park,
Right.
and all of these urban areas are mainly competing with suburban areas that are really built that way. I think it's great. I do like being here near the action, but generally, I do think that it's probably going to trend towards some of these smaller, like micro communities where people are like, "Hey, my office is here. I live right here. All my restaurants are here. I can kind of hang out in my little communities." Um, so yeah, I have a slide. I love to part of this role I really enjoy is the relationship piece. Real estate's a relationship business. I have 1,200 individual clients here through Columbus. If anybody's personally interested in learning more about CoStar and using it as like as a tool to help find deals, underwrite deals, more than happy to talk. I won't give you the hard sell, but if especially if you're planning on aggressively growing your portfolio, it's one of those things where it's based on inventory. So if you're kind of early on in your journey, it's definitely more affordable when you get started. But it's definitely a premium product, and it's something that we're going to give you the best data. So if not even a official like sales inquiry, this is my QR code for LinkedIn. I'm pretty active on LinkedIn. I just try and post a lot of stuff around sales, marketing, business development, the occasional fitness stuff, the occasional just like young professional type stuff.
Getting after it.
Um,
Yeah.
what's that?
You say getting after it and all of that. Yeah, but I see
Yeah,
you running
yeah,
a marathon,
getting
man.
after it. The occasional like, hey, I ran a race,
Yep.
and then let's talk about hitting the phones. So yeah, would love to keep in touch with anybody. I was here about 12 months ago to speak when these events were still in person, and we talked a little bit more about submarkets and rent growth and things like that last October. So I may know some of you who are on this call. Otherwise, I hope this was informative. I hope I didn't talk your ear off too much.
No, you're good.
I explained the concepts pretty well, but so Xavier, feel free to take us home.
All right. And that wraps everything up here. Thank you everyone for joining the Elash Apartment Connections. And thank you, Eli, for joining us tonight and giving us a fire hose of information. Great and great and valuable information. We'll say thank you and we appreciate your time, man.
Hey, good to be here. Thanks again, man.
Thank you. Bye-bye. Perfect.